Oil prices are high, inflation is strong, and stocks are in the red everywhere right now. The value of the US stock market, if you count from the beginning of 2026, has dropped by about $4 trillion already. If you ask whether it will drop further, you can check the technicals first. Right now, the drop has reached a key support level from last year, which is around 6,500 points. This support level is basically the entry cost for people who just got in last year. So if it breaks below this point, investors who entered the market last year will be at a loss. This could make everyone panic and destabilize the market. You might ask, how come? Oil prices are high and inflation is strong, right? But US inflation numbers haven't gone up yet. Wait, because when the government announces inflation figures, they always follow oil price hikes. Data collection takes time. Right now, forecasts already suggest inflation might rise to... It could go as high as 4, even 4%. If inflation rises that much, then everything will get a lot more expensive, and stock market prices will change as well. As for the stock market trend, it might just do a complete backflip. Why is that and what will happen? I'll explain it all in this video. Support this video about expensive oil, high inflation, and red markets everywhere from the Save Money Monster channel by scanning this QR code. Or if you want to support the Save Money Monster channel in a super easy way, just hit like, share, subscribe, leave a comment to chat, or save it to watch later. But what I'd love most is if you could subscribe. If you've already subscribed, no need to do it again. If you haven't, just hit it once. That way, when I upload a new video, we'll see each other again. Sound good? Thank you. The negotiations between the United States and Iran still haven't reached an agreement, so the market could still crash further. Oil is expensive, inflation is high, and stocks are in the red everywhere. Before the US stock market bounced back recently, it had already lost $4.1 trillion in value since the beginning of 2026. Inflation, just how high can it go? Let's take a look at this chart and let it tell the story. Right now, it's about 57% higher than before the war started. So what's the situation? Well, on February 28, 2026, which was the start of the latest round of war between the US, Israel, and Iran, oil prices shot up by 68% in just one day. After that, it seemed like Donald Trump was looking for a way out. So he said, hey, let's negotiate to end the war. As soon as he said that, oil prices dropped by 19%. Suddenly, he said, I was just kidding. But then he got frustrated and said, no, let's attack Iran instead. Immediately, oil prices shot up another 14%. Oil prices are now almost 60% higher than before the war. The one responsible is President Donald Trump. Confused, he doesn't know what to do next. The whole world is suffering with no way out. While Trump still can't find a way out, there's one person. They didn't do anything, but the way out just came crashing right into their face. And that's the US stock market. If you look from the beginning of 2026 up to the point where it really dropped, not counting the most recent bar since I'm writing this on March 4th, the US stock market has already lost about $4 trillion in value. At this point, the S&P 500 has dropped from the beginning of the year to around here. This is an important support level at 6,500 points. You can see that last year, whenever it dropped, it hit this line again and again. That means this line is the support. It's basically last year's cost price. To put it simply, this is the cost basis. Anyone who entered the market last year bought at what was probably the lowest price. So if it breaks below this line, even those who just entered the market last year and bought at the lowest price, if it breaks, they'll all be at a loss. And if that happens, it could affect people emotionally. Their hearts might race, they might panic, get scared, or be startled and hit the sell button. When a large number of investors get scared and start selling, that's when the market usually drops. And when falling stock prices meet with expensive oil prices, it turns into a total disaster, like a boy band gone wild. Honestly, I really wish these two would split up, but they're stubborn. Because when these two things come together, it leads to inflation that gets even worse. And if inflation becomes really severe, the prices of goods will skyrocket and the market will flip upside down. If inflation rises so much that it outpaces the returns investors are getting, what we call the real rate or the actual rate of return for investors, if that turns negative, it will trigger what's known as an unwind position event, where investors close their positions. Now, those last two sentences might sound a bit confusing. They use some tougher technical terms. Can you explain it more clearly? What exactly does it mean? Sure, on Sci Money Monster, we won't let you down. Everything will be easy to understand step by step. Let's start like this. Anyone who's been following economic or financial news, or even people who do business, probably already know that oil is the cost behind everything, whether it's goods or services, literally everything around us. And it's a direct component of the Consumer Price Index, which is used to indicate whether inflation is happening or not. So to put it simply, if oil prices go up, then everything around us, goods, services, whatever, will get more expensive too. And when products become more expensive, that's called inflation. If someone says, is it really inflation? The inflation rate numbers haven't gone up yet. Just be patient. When the government announces any inflation rate, they need some time to collect the data first. The announcement of the inflation rate always comes after oil prices have already gone up. It usually takes about a month for them to gather all the data before they announce the inflation rate. Since February 28th until now, as I mentioned, oil prices have risen by almost 60% compared to before the war started. That means, don't worry, everything is going to get a lot more expensive. Seriously. So if you ask about the inflation rate in the United States right now, it's at 2.4%. But there are forecasts that the inflation in the United States, it's expected that inflation could go up to 4.5%. As I mentioned, if inflation rises that much, it could completely flip the market upside down. Why is that? Because inflation erases the returns that investors get from the market, making the real return for investors negative. For those who study stocks and investing, today is a really good opportunity to learn about the term. Real rate of return is the actual return investors get when they buy stocks. For example, if you make a 5% profit, don't think that investors actually get the full 5%. You have to subtract the inflation rate first, and only then do you get the real return. This doesn't even include taxes. If the return from stocks is still higher than the inflation rate, that means you're still making a profit, right? In that case, investors aren't too worried. They're still making money. So people keep trading stocks. But if the inflation rate surpasses the return investors receive, that means you're actually losing money. For example, let's say you invest $100 and you make a profit of $5 per share. That means you've made a 5% profit, right? But that 5% doesn't all go into your pocket. You also have to check what the inflation rate is at that time. Let's say inflation is at 2%. So your real return would be, you have to take that 5% and subtract 2%. So your real return is 3%. That's your actual profit. It means you only made a 3% profit, but still 3% is positive and it's still a gain. But if inflation goes up, let's say to 6%, you get a 5% return from stocks, right? Take that 5% and subtract the 6% inflation, and you end up with a loss. Your real return is -1. This is what we call a negative real return. So if regular investors know that putting money in the stock market will result in a loss, their first thought is, well, I'd rather put my money somewhere else, right? So let's ask, what is the actual real return of the S&P 500? This is a question that can be answered as follows. The answer depends on how far back you look. When we say now, what period do we mean? Generally, we usually look at the past year. So if you ask what the real return of the S&P 500 was over the past year, let's see. Over the last 12 months, the S&P 500 returned an average of 3.2%. Start with that 3.2%. Then check the average inflation rate over the past 12 months. The inflation rate over the last 12 months was 2.5%. So take the 3.2% and subtract 2.5%, and you get the real return of the S&P 500 over the past year, which averages out to 0.7%. That's not even 1%, but still, it's a positive number. However, this figure is from before the war started. So if you ask, well, what about right now, literally right now, let's just look at 2026. If we look back, what's the average return of the S&P 500 from the beginning of 2026 up to now? It's 0.1%. That's the return rate of the S&P 500. And what about inflation? The latest inflation rate is 2.4%. So if we take the 0.21% and subtract 2.4%, which is the inflation rate, that means the real return of the S&P 500 is negative 2.19%. That's a loss. This is what's called a negative real rate of return, meaning the actual return is negative. And this is with the latest inflation rate at 2.4%. If inflation actually goes above 4%, imagine the loss. Wouldn't the market be devastated? I wonder if inflation hits that level, what would the market look like? So I checked if this has happened before, and yes, it has, several times. Let's look at the S&P 500's real earnings yield since 1960. Wow, Sai, why dig up something from so long ago? Where did you find it? Honestly, I just get curious and want to know everything. Looking at the data from 1960 onward, we can see that real yields turned negative several times, meaning investors' returns were in the red because they couldn't keep up with inflation. There have been quite a few instances like that, but the most notable ones on the graph are Black Monday in 1987, the dot-com crisis in 1999, and the subprime crisis in 2007. Then I tried overlaying the S&P 500 graph on top of it, and you can clearly see that every time the real yield goes negative, meaning returns can't keep up with inflation and end up in the red, it always lines up with a bear market in the S&P 500, every single time. And when it's a bear market, the drop is usually around minus 20%, but at its worst, it can go down as much as minus 60%. And every single time the real yield is negative, or the real return is in the red, there hasn't been a single instance where there isn't a single time. Why? Because when inflation beats returns, investors realize they're losing money. And once they realize that, what do? They sell. It's a chain reaction. Someone panics, or when a lot of people start selling, even more join in. That's when everyone rushes to dump stocks and the market crashes. Honestly, researching this made me wonder, does anyone else see it this way? This whole thing about the market crashing and a recession, honestly, people have been talking about it since 2022, back when Russia invaded Ukraine and oil prices shot up by about 30% above pre-war levels. Hey, that's exactly the same situation as now, right? So why didn't a recession happen back then? I found some information that suggests it was partly luck, just luck. But it's not entirely just luck. There are reasons. Back in 2022, it was right after COVID, right? During COVID, they injected money into the economy. I'll explain in a bit how they did it. But what I want to say is, after all that stimulus, if you look at savings rates, let's use the United States as an example, because the numbers are easy to find. Personal savings as a percentage of GDP in 2021, everyone's savings were really high, right? Super high. That's because at that time, the Biden administration stimulated the economy by handing out $1,400 checks and printing more money to boost the economy. At that time, every country was doing the same thing. M2 just skyrocketed everywhere. Every country, really. And there were economic stimulus measures. Like in Thailand, we had the Khon La Krung half-half program, or the We Travel Together campaign, remember? So when the oil shock happened, oil prices jumped 30% in 2022. People had a shield, which was their savings. That's why people could dip into their savings to spend and take care of themselves first. And once everyone, all the citizens, had their own personal shield, it meant that savings, which kept the economy from falling. But do you know why? That savings wasn't much. Despite what people say, it really wasn't. Because when 2022 happened, it didn't last long. It wasn't dragged out. If you look at the savings line from its peak, it dropped. That's because people had to use it, right? Looking at this graph, by 2026, savings won't match 2021 levels. People no longer have a personal shield. The savings they could rely on in 2022 are gone. Again, emergency savings are a really vital shield. If you have none, start saving right away. 3 months is the minimum, 12 months is what you'd call. Another thing that kept the market from crashing hard in 2022 was the unemployment rate. It was low. Most people had jobs back then. They had jobs, they had savings, so when the crisis hit, it wasn't that bad. But you'll notice that since 2022, the unemployment rate has been gradually creeping up. And this graph, I've seen it for a while now, but I wanted to show it in this clip. You'll see that every single time, whenever the unemployment rate rises significantly, it almost always overlaps with a recession. So in 2022, we made it through because first, people had savings, and second, people had jobs. But this year's different. Oil prices are surging, savings are low, and the unemployment rate is high. Now we really have to wait and see. Will things get even worse? Now, people often say, "Oh, Sai, you've been talking about all this doom and gloom." So tell us, for those watching this video, if we want to invest or do something, what should we do? The first thing I'd say is to keep your emergency savings intact. Check if you have enough for 2 months, 3 months, 6 months, or even 12 months. You know how much you need to spend each month, so make sure you have enough emergency funds set aside. As for your job, I'd also like to suggest you can see that this year, there's really no such thing as job security, so you need to have backup skills. Think about what else you could do. Imagine if tomorrow your company suddenly announces, "Hey, we're drawing lots for layoffs," and you end up being one of them. You need to have a backup plan. As for the question, well, is there any opportunity to invest during a crisis like this? There are opportunities when the market drops sharply like this, especially because oil prices are high. If you ask which companies benefit, the first sector that comes to my mind is all the oil infrastructure companies. Whether it's drilling, extracting, or selling oil, they all benefit because their business costs stay the same, but the price of oil goes up. That means they can generate more profit. So this group benefits, is likely to make more profit, and could expand or hold steady. Something like that is possible too. Right now, honestly, the only thing that's going up is the red sign at the gas station. The next industry that I think will benefit is the clean energy sector. But if you ask which one stands out the most, it would probably be nuclear energy, nuclear power, because it seems to be widely used and is the most practical. Then there's hydropower. For example, China is the largest in the world, right? As for solar, China is still the biggest player there too. But wind power and things like that are a bit hit or miss. It's not very stable. What's important is that the rise of clean and alternative energy industries isn't just because people are afraid of relying too much on oil and worried about situations like this happening again. Another reason is that we need energy to supply the AI industry as well. The AI industry requires a lot of stable energy, so they need to have their own backup power sources. This is why alternative and backup energy industries are becoming more important. There's a chance for growth here because AI consumes a huge amount of electricity. Another thing I think about is if we're going to have infrastructure for alternative energy, metals will be important. Basic metals used to build energy infrastructure, and the industries that produce these metals should benefit. One metal whose price hasn't surged yet is copper, which is also an asset, and it's really used in the energy industry. Also, if we're going to expand power plants, we'll need even more metals. This is just my personal opinion, not investment advice. To wrap up and end the clip, may everyone's money be safe and protected. May you be so wealthy you can't handle it. Amen.